The bear continued to gain the upper hand on the euro-dollar market upon ECB President Mario Draghi's stand to remain accommodative on worsening CPI numbers coming out of the Eurozone. This has sent the euro-dollar market into a trading range as market awaits the release of US non-farm payroll to establish new price discoveries. Good morning, everybody. It's now 1 p.m. Auckland time, Friday, January the 10th, and this is your Forex market commentary brought to you by REAL ECN. In today's discussion, we'll go look at the euro-dollar market. First in line will be the technical commentary. On the technical front, the euro-dollar market fell lower on yesterday's European trading session during the ECB rate meeting. ECB President Mario Draghi announcements of keeping the Eurozone benchmark rate at 0.25% is in line with analyst expectation, which explained the market pricing out the expectation in late December of 2013, observing the topping of the euro at 1.3820 level. The causality of the correction in the euro-dollar market is in early 2014 can be linked to retail open short positions diverging significantly from its net long position trend. This indicates that it has been the most net short position taken by retail traders since the beginning of the year, begging the question, is this extreme market sentiment indicative of a major top or bottom? Fundamental risk events can give further support to any changes in the market sentiment, and the biggest one would be the release of during today's trading session, and that's the US non-farm payroll numbers. Currently, the euro-dollar market is trading in a consolidation range with no clear bull or bear bias, as market awaits for the new trend to break through the 1.3655 level for bullish sentiment to turn or break below the 1.3520 for a bearish momentum to maintain itself. The 4 hours chart established the Fibonacci resistance at 1.3623 level and the support at 1.3579 level. Analysis of a collection of technical indicators in a 4 hours time interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend short position on the euros. Now it's time to analyze the indicators on the 4 hours time interval. First off, we have the RSI, which is the relative strength index. It is the momentum oscillator. It measures the momentum of the trend. Right now, we have a price value of 46.733, which is the momentum is relatively weak with technical recommendation of a neutral. Moving down 2 notches, we have the MACD, which is the moving average convergent divergent. We have the 12 days EMA is sitting below the 26-day EMA, give you a price value of minus 0.003 with technical recommendation of a sell. Moving down 1 notch, we have the ADX. Remember, if ADX value sits above 25, it shows that the trend is really strong. Right now, it has a price value of 35.415 with technical recommendation of a sell. Moving down 2 notches to CCI, which is Commodity Channel Index, it confirms a buy or sell signal, and it also measures momentum as well. So when the price value sits around the 0 level, it is relatively neutral. And if it's around minus 100, it is a sell strong signal. So right now we have a current price value of minus 11.2179 with technical recommendation of being neutral. Lastly, we have an ultimate oscillator. Remember, if ultimate oscillator is above 50, it measures the bullish sentiment. And if it's below 50 or sitting at around 50, it shows that it's really weak. So right now, ultimate oscillator price value is sitting at 49.241 with technical recommendation of neutral. So overall, we have 0 buy, 6 sells, 4 neutral, and a technical consensus of a sell. Remember, the sell signal is based on the 4 hours time interval, as the euro-dollar is trading in a tight consolidation range. So now it's time to explore the fundamental commentary. Upon a disappointing CPI number coming out from the Eurozone biggest economy, Germany, has prompted the ECB President Mario Draghi to come to its defense of maintaining its forward guidance policy with strong language, implying that he will employ all necessary instrumental policies to combat the downside risks associated with the softening CPI number. Speculators are also paying close attention to today's release of Eurozone GDP year-on-year number with forecasts of a contraction of 0.4%. The multiple reiteration of Draghi's action to tackle worsening CPI figure by maintaining a lower benchmark rate as well as negative deposit rates signal to the continuation in euro bearish sentiment. With the final blow to euro trading lower on Monday would be an upbeat and better than expected US non-farm payroll number. Remember, it is important to understand that the importance of non-farm payroll number cannot be understated. Non-farm payroll and U.S. unemployment claims number are both critical gauge to the Fed's tapering structure. An upbeat and better than expected number upgrade expectation by the market that the Fed can accelerate rate, by which it taper its $75 billion a month QE program. Also in line with Fed mandate to monitor unemployment rate, options of rate hike would not be discussed until unemployment eventually fall to a comfortable level of 6%. U.S. initial jobless claim fell to 330K from 345K in prior months, beating the forecast of 335K. Today's U.S. non-farm payroll is forecast to be at 196K from a previous of 203K, with unemployment rate expectation remain unchanged at 7%. Currently, the euro-dollar market is ticking higher and recover all the losses induced by yesterday's Draghi's announcement. The reason underlying this is investors are doing profit-taking ahead of the release of U.S. non-farm payroll. Quite often, the market becomes quiet and defensive as volatility associated with the release present itself as too much of a risk for retail trader to manage.